meow, meow. What? Cat. Caterpillar Inc. And down she goes. Alright, what do we have here? Monthly candle chart. Monthly candle chart. First thing, right away. Where are my boundaries? Where's my technical defined, monthly defined resistance? So until we get back above, we have close above 163. This is to avoid as a long play. Here was some monthly defined support. Defined, hit, bounce back up. Still have the 12-month moving average pulling the price action up, giving you a chance. But right here, when you have that close on the candle below 12-month average, you should be out. Not a short. You don't get back in if the price action closes above. You're just out, and then you wait and you reassess. Because if you go back up here and that green candle, oh, close above 12-month average, I'm back in. Well, there's damage. All these buyers now are trapped. They become sellers. They become resistance. So what you have to identify is where's the threshold where I'm out of the woods, where all that damage has been mostly evaporated, so that you have to go up, see where that resistance is being defined, and then if you have a close above. So you get triggered out here, you're out. If you really want to play Caterpillar, you don't want to look for other stocks that are starting to break out, that have give you better risk to reward ratios. Then you'd have to wait for a sideways move on top of the 12-month moving average, on top of monthly defined resistance, and then you could play. But these plays in the weight of evidence of this scheme, the grand picture, when you've had this far away, look at how far that candle is, that price action for the 12-month moving average. That is exponential. Look at that 12-month moving average. Look how far you are. You're up here, and the moving average is at 126. 126, and the high 173. That's 40% over. There's a pullback that happens eventually. See how far it goes? You wake up all those sellers, they bring back down the price, and that creates damage. Every time you see that goes up, goes down, creates damage, and then after that, look how long it would have taken for you to get back in to beat those previous highs. Because you see months go by, and if you didn't exit, you bought here, I'm going to wait for next rally. Well, a whole lot of people, they want to exit also, and that's all those sellers, all those buyers now turn sellers, and you can't even go above that previous high because all those sellers, they want to break even. And then after that, you have to churn, you have to wait, you have to evaporate all those sellers here that didn't sell, give up, they sell, and eventually you have buyers coming in thinking it's a bargain or it's a good price, and then since there's no sellers, price action goes back up, and no. So all that has to work. Plus, you have to have underlying conditions, macro technicals, how the market's doing, how the industry's doing, the sector's doing, how the company's doing. Did the CEO go on start going crazy? And after that, a whole bunch of stuff. As time moves on, a lot of stuff could influence the price, other than just the mechanics of people getting trapped and wanting to get out. So you need time to heal these cut wounds. These are huge candles, red candles on the monthly candle chart. And it just takes time, guys. So here you would have been trapped for 7 years. Long time, guys. 7 years. Over 7 years, you'd be stuck here in Caterpillar if you were buy and hold. Don't do it. Worst case, use the 12-month moving average to get out. You would have entered here, maybe, but you wouldn't be shorting here. And no close below 12-month average, and then you exit here. That's pretty nice. Avoid this. Avoid that. You want to ride that. All right. That's my rant. So where are we now today, knowing that? Where we have closed below the 12-month average, went back above, below, back above. It's all right. You're not getting trapped. Weight of evidence. You're still below that monthly defined support, resistance. You're not getting into any action. You see, if you would have been playing on the daily, on the weekly, you have a whole bunch of weekly and daily closes above that monthly defined resistance breakout line. and that could have trapped you thinking that the stage 2 was continuing. So you always go on the monthly, draw those lines, and if you go zoom on the weekly, as we're going to see, you're going to see and say, oh, look at that line. It saved me. And look at that. No price action. Complete reversal. Back in. Try to bounce back up. And after that, gapped up. And 12-month average starting to serve as resistance. It's declining. And then you're getting sucked back down below that monthly defined support and resistance. 12-month moving average, the trend is down. All right, let's zoom in on the weekly. You see all that? Oh, price action's above. I'm getting in. Wait. No, noise. On the daily, we would have had even more closes than on the weekly. Oh, here. Oh, I'm back in. No. Weight of evidence, a whole bunch of other things you have to look at before you get in. The more you look at it, the more it'll be easy, the more it'll become instinctive. Where's my volume candles? First thing you want, green volume candle like this, twice the average of the previous 4 weeks. That's one of the part of stance triple confirmation. You want to be outperforming the SPX. You want to be above a horizontal breakout line. You want to be above the 3-week average, inclining 3-week average. If you don't have all that, there's no reason to play, especially here. Red zone, gray zone. You don't have all the criteria to enter. So all that, you could have avoided these whipsaws. All right, 3-week average going downwards. For a brief moment out of it. Resuming the downtrend. Underperforming the SPX. And now we're below the Ichimoku cloud. Ooh, and look at the damage. It's like you're playing a video game. And then you're in a red zone getting damage. You need time to heal. And if you get hit with another sword strike before you have time to heal, it double hurts. Ichimoku cloud bouncing off that monthly defined support. Ichimoku cloud price action sucking it back up. Back down, hitting that monthly defined support right here. From those previous highs way back then. Well, they're still there, guys. It's invisible, but it still has some bearings that it explains the bounce back up. All right. So 30-week average is declining. You're built under the cloud. If you want to, if all that looks messy, well, keep it simple. Lower highs. Lower highs. Look at that. Downtrend, lower lows. All of these. Lower lows. Downtrend. You want to know in the trend, what trend you're in? Down. Until you have a 30-week moving average violation. Until you have a higher high. So the price action goes back down. Bounce here off the support and resistance, off 30-week average, go down. Oh, this time the support didn't hold. We go back down. Oh, bounce off that support and alternate resistance, go back down until you hit some more resistance, etc. And when price action closes here, then you're out. When the price action is above a previous high, you're also out. If you have a trend line violation, if you really want to be aggressive, if you have a use 3 points for a valid trend line. If you break on the 4th, you take half your position out. 1, 2, 3, 4. Here you would break, and usually they pretty much all overlap. So when the trend line violation usually is the first one that happens. Then after that, the 30-week average and happens, and then the pullback within the pullback for high over a previous high also happens, especially if the price action is far away from the 30-week average. It might happen. This might happen before you have that last final warning that the 30-week average close above it, and then you should really be out. So that's pretty much stage analysis, keeping it simple. But this huge red candle on a down day, big telltale sign. You have a rally, but on contracting volume. So don't trust. That means it's not going to be a reversal. Less chance of being reversal. So that's actually a pretty good entry. Maybe we have to wait until the Mansfield. Never short the Mansfield's going up. Relative performing the SPX. Wait till it goes back. Starts going back down. That means those green candles going to start having red candles. And after that one starts going back down. That's a good entry point right here. Close to that monthly defined support, turn resistance, close to 30-moving average. Very good risk to reward entry right there, guys. Okay, cat looks erratic, but when you go and you do the weight of evidence and look at all the elements, you could clear up any chart and really get a focus on what to expect of it and some of the best moments to enter and exit to maximize a successful trade, guys. Thanks for watching and subscribe. Thanks. Meow.